The world of cryptocurrency has changed dramatically with the rise of Bitcoin exchange-traded funds, ETFs, a regulated financial product that lets investors gain exposure to Bitcoin without directly owning it. Unlike buying Bitcoin on a crypto exchange and storing it in a wallet, Bitcoin ETFs trade on mainstream stock markets just like any other ETF. This makes them familiar, accessible, and regulated. Their approval, especially in the US, represented a key turning point for crypto markets because it meant Bitcoin was no longer confined to niche crypto exchanges, but was now part of mainstream finance. Keep watching till the end to understand how Bitcoin ETFs affect institutional investment, retail access, market trends, and your own crypto strategy. What is a Bitcoin ETF, and how does it work? A Bitcoin ETF is a financial product that mirrors the price of Bitcoin, but is traded on regulated stock exchanges instead of crypto exchanges. When you buy a Bitcoin ETF share, you're essentially buying exposure to Bitcoin's price movements through a regulated fund. ETF providers like BlackRock and Fidelity purchase real Bitcoin to back the shares they issue, meaning ETF investors don't have to manage wallets, private keys, or deal with direct custody risks. The fund does that for you. For many investors, this structure is simpler and safer because it's similar to how traditional ETFs for stocks or commodities work. Moreover, because ETFs are regulated under securities laws, they offer daily disclosures, audit requirements, and investor protections. Institutional adoption, opening the floodgates. One of the most profound effects of Bitcoin ETFs has been the influx of institutional capital. Large financial firms, pension funds, and sovereign wealth funds traditionally have limits on where they can invest. With Bitcoin ETFs, these institutions now have a compliant vehicle to include crypto in their portfolios. This has resulted in record inflows in the hundreds of billions of dollars globally, signaling that institutions no longer view Bitcoin as speculative fringe tech, but as a serious asset class. In Q3 2025 alone, US Bitcoin ETFs attracted massive institutional investments totaling tens of billions, and some funds have grown into the largest Bitcoin holders in the world. These inflows not only boost Bitcoin's liquidity, but also build confidence across the broader financial ecosystem. Lower barrier for retail investors. For everyday investors, people with regular brokerage accounts, Bitcoin ETFs represent a game changer. Previously, to invest in Bitcoin, you had to open a crypto account, understand wallets and keys, and manage security risks. Not everyone has the desire or expertise to do that. But with a Bitcoin ETF, you can buy exposure through your regular stock account, just like buying Apple or index ETFs. This removes technical friction and makes crypto accessible to a much wider audience. ETFs also fit easily into retirement accounts, mutual funds, and 401k plans in some regions. This democratization means more diverse participation, from seasoned investors seeking portfolio diversification to beginners looking for regulated exposure to crypto. Impact on Bitcoin price trends. Bitcoin ETFs have had a noticeable effect on the price of Bitcoin. Because these funds must buy actual Bitcoin to back ETF shares, every dollar flowing into ETFs translates into real Bitcoin purchases in the market. Given Bitcoin's fixed supply, this creates additional buying pressure and reduces available market supply. For example, ETFs once recorded daily inflows exceeding $1 billion, significantly tightening supply and contributing to price surges past historic milestones. This connection is now strong enough that many analysts view ETF inflows as a leading indicator of price direction, with robust inflows often coinciding with bullish momentum in BTC's price charts. Price discovery and market efficiency. Another impact of Bitcoin ETFs is on how Bitcoin's price is discovered and formed across markets. Traditionally, crypto price discovery happened across multiple exchanges, with fragmented liquidity and varied pricing. However, research shows that ETFs, especially high-volume ones, such as BlackRock's IBIT and Fidelity's FBTC, have become central in price setting due to their volume and regulated trading. This shift means that the ETF market itself often drives Bitcoin prices, helping align prices across platforms and increasing overall market efficiency. The result is a more unified and transparent reference price for Bitcoin, which benefits both retail and institutional traders. Regulatory confidence and crypto legitimacy. The approval of Bitcoin ETFs, particularly in major markets like the United States, has sent a clear signal. Crypto is here to stay. Regulatory bodies that were once skeptical have moved toward frameworks that recognize digital assets as investable instruments. This legitimacy draws not only capital but also financial infrastructure, from custodial services to risk management protocols designed to support institutional participation. This regulatory confidence has contributed to broader acceptance of crypto products, encouraging other markets to explore similar regulated offerings like crypto ETFs and inclusion in retirement accounts. Risks and considerations for investors. Although Bitcoin ETFs offer many advantages, investors should be mindful of risks. ETFs still expose holders to Bitcoin's inherent volatility. Large institutional flows can amplify price movements on both upside and downside. There are also management fees and premium/discount issues. Sometimes ETF shares trade slightly above or below the value of the underlying Bitcoin, depending on demand. Regulatory changes or market stress can also impact ETF performance. Moreover, because ETFs are tradable on stock markets, they are subject to broader market sentiment and could react to non-crypto events just as much as crypto-specific news. What Bitcoin ETFs mean for portfolio diversification. For traditional investors building diversified portfolios, Bitcoin ETFs offer a new asset class that behaves differently from stocks, bonds, and commodities. Crypto's historical low correlation with traditional markets, although rising post-ETF, provides potential diversification benefits. Because Bitcoin tends to react to different drivers, such as technological adoption, regulatory shifts, and supply scarcity, it can offer balance when equities or bonds face pressure. Long-term outlook, growth and innovation. Looking ahead, Bitcoin ETFs may continue to shape both crypto markets and global investment landscapes. Projected growth in ETF assets under management suggests ongoing institutional interest and expanded retail participation. Emerging products like Ethereum ETFs and diversified crypto ETFs signal that Bitcoin's ETF success may pave the way for broader digital asset adoption in regulated finance. As infrastructure continues to improve, with better custody, clearer regulations, and more financial products, crypto could become a staple in diversified portfolios. How should individual crypto investors respond? For individual crypto investors, the rise of Bitcoin ETFs presents both opportunity and strategy questions. If you're active in markets, ETFs can be an efficient way to gain exposure while reducing the complexity of direct Bitcoin ownership. For long-term holders, ETFs can supplement your portfolio by providing regulated exposure alongside direct Bitcoin holdings. Newer investors might find ETFs a good entry point into crypto without dealing with wallets and exchanges. Bitcoin ETFs have reshaped how investors access and interpret crypto markets. By bringing mainstream regulatory oversight, institutional capital, and broader accessibility, ETFs are turning Bitcoin into a more recognizable and investable asset class in global finance. That's all for today's video. If you found this video useful, subscribe for more guides. Leave a comment with your thoughts and share this with friends and fellow investors. Thanks for watching. Have a wonderful day.